sets of numbers were released today, one by New Delhi and the other by Washington. Both these numbers represent the health of our wallets and influence our financial behavior. We're talking about inflation that has become a nightmare for millions around the globe. First, the good news. Retail inflation in India has slid to a 15-month low to 5.66% for the month of March. Some of the relief has come from falling vegetable prices, and food inflation has moderated to 4.79%, down from 5.95% last month. Retail inflation in the US, on the other hand, has eased to almost two-year low, with annual inflation at 5%. Month-on-month increase was just 0.1%. So, is the over-year-long attempt by central banks to tame inflation finally working? Are we going to see a pause in interest rate hikes? To speak more on this, I'm joined now by Siddharth Sanyal, Chief Economist at Bandhan Bank, Madhavi Arora, Lead Economist at Emkay Global, and Geoff Dennis, Independent Emerging Markets Commentator. Welcome to all of you, and thank you so much for speaking with us. Mr. Sanyal, let me begin with your take on the India CPI data. It was expected to be below 6%. Are we seeing a base effect in play, or is there now some real relief on the horizon?
There is an element of base effect, undoubtedly. Nevertheless, softening of the headline inflation still a very, very good news. And also, if you see, it's not only softening in the headline inflation below 6%, towards closer to the market expectation in this particular round. There has also been perceptible softening in core inflation number also, which was bothering the central bank for a while. Now, what is very important here is now all of a sudden we are seeing a patch where the real policy rate seems to be something like 100 basis point higher compared to where it was still a few days back. So overall, pretty good news.
Good news coming in there, Madhavi. Do you second that? That in hindsight, or just a few days later, the RBI decision to pause on interest rate hikes is beginning to make sense?
This print was largely expected. I don't think the RBI was not aware of the fact that there is a base effect which is already running its way through the next 1 year as well. So we will see inflation actually coming off to a sub 5% in the next policy itself. So this disinflation trend is known to central banks across the world. What has changed for the RBI, I think, in terms of their anchoring of the, their own reaction function, is basically what has happened in the global dynamics, right? So beginning of March, we were discussing Fed terminal rate to be probably close to 6%. In fact, the Fed chair himself was stating that, they would be revising up their, their dot chart, as well as probably will be going in for a 50 basis rate hike. And then we see the banking crisis really brewing, which sort of made them feel that, maybe speed can kill, and they need to sort of take cognizance of the fact that there could be some damaging factors which could probably have a multiplier effect or could have a systemic risk as well. So that has led to, Fed sort of sticking to its gun in terms of what they were talking in December, where they were looking for a terminal rate to be going at the maximum of 5.25%. Now, the market has obviously reacted to the way Fed has sort of changed their policy stance, and now is looking for almost 150 bips rate cuts in the next 1.5 years, which obviously has a rub-off to the Reserve Bank of India as well, because that is also now realizing the fact that possibly, they could also be seeing the spillover of the same in terms of, how speed could have a very damaging impact to certain part of the economy, because clearly emerging markets economies at least did not have the same kind of growth dynamics that the West was seeing. So I think net-net, what has essentially happened is that the Reserve Bank is reacting largely to what is happening to the world. Their anchoring has changed from inflation to now what is happening, in the Western economies. So I think the CPI print was largely known in terms of the trend. What has essentially changed for them is how the world is now being perceived by, policymakers in general.
Geoff Dennis, initial gains on Wall Street on the back of these inflation numbers in the US seem to have eroded to some extent. Is it telling us that inflation concerns still persist and this one set of data is not going to be enough?
I think it is, because I think what investors should be doing now, and I think what the Fed is doing now, is focusing on the core rates, where it was very clear the headline would drop sharply this month because you had such an easy base effect compared to March of 2022. So 6 to 5 looks pretty good. On the other hand, the month-on-month rate of core inflation remains pretty strong at 0.4. And indeed, if you calculate the 3-month annualized rate or the 6-month annualized rate on core, you're still somewhere around the 4 to 5% level, which is too high for the Fed. So headline inflation year on year has now dropped below core year on year, which is the first time it's done that for quite a while. And therefore, I think what the market is doing is having a second look at these core numbers. And what these core numbers mean for sure is that the Fed is going to raise interest rates one more time anyway at the beginning of May. Obviously, we have to wait to see what data could come out before then. But this looks like a green light for the Fed to raise rates one more time. And in fact, before we really get some sense that we are completely getting over this inflation problem in the US, you've got to see core inflation come down a bit more. So the headline results were great. The core inflation results were not so good. And I think the market on a second look is reacting in that general direction. And of course, behind the scenes, you've got anyway the ongoing concern about, if the Fed over tightens here, given that you've got tightening credit conditions anyway after the recent banking crisis, and you've got softer economic data that's come out recently, there is a fear that if they over tighten, you've got recessionary fears. So it's still a very difficult balancing act for the Fed. I want to see core inflation go a lot lower yet before you can really expect the Fed to declare victory.
Too early for the Fed to declare victory, too early for all central banks to declare victory. That's really the real question, Mr. Sanyal. Their efforts are paying off. We're seeing inflation cool off, but if you look at the IMF projections also from yesterday, they say inflation is not coming down as fast as expected. Will that still be a bit of concern as far as central bank action is concerned?
Well, absolutely. This is some bit of early one particular battle won, you can say, but the war is still not over. So central banks in today's world, given the complex and volatile situation, they cannot really take it easy. They have to be very, very vigilant on a number of aspects. Now, in the context of US also, I think a very important factor is that while the median expectation is that the Fed will be hiking just one more time, you cannot ignore the fact that 7 out of 18 Fed governors are actually talking about more than one more hike. So some of them are calling for 2 more hikes from here. Some are calling for 3 more hikes. And there is at least one governor who is calling for 4 more hikes. So the important factor is to figure out over the course of the next few weeks and months how exactly the Fed dot plot change, how is the expectation about Fed policy changes over the course of the next couple of months. So if Fed indeed stops at after delivering 1 more hike, I think from an RBI's point of view, it will be seen as some kind of a relief and some kind of a breathing space. If there is an indication that Fed continues beyond 1 more hike, then possibly there is a different story altogether. What is important? It's not only on the part of RBI and India. I'd like to flag that what was so not only the inflation, softer inflation and core inflation trend over the course of the last few months. What has also allowed the central bank to breathe slightly easy is the improvement in the trade account and current account deficit, and that's why some kind of a relatively more stable currency. I think that has also provided the Indian central bank a little bit of confidence, and it's very important that we continue to see that persisting over the course of the next few months. My sense is that will persist. We were very vocal about expecting a pause in this particular policy, which turned out to be the case. My sense is that the bar for getting into a fresh round of hiking on the part of RBI is relatively high. But if for whatever reason global inflation disappoints on the higher side, or Fed starts talking about hikes beyond 1 more hike, then it's a very different scenario altogether a couple of months down the line.
So that's great, Mr. Sanyal, if you all saw that pause coming, because it took many people by surprise when the RBI decided to, hit a pause but not a pivot in the last MPC meet. But Madhavi Arora, coming to the point of whether we're at the beginning of a cool-off of this inflation cycle and whether that data now seems to make itself clearer with most of the pain behind us.
So, see, we already have seen the peakflation theme play out, I think since the latter part of the year. But clearly, I think the bigger question is that when it really sustains in terms of the downturn, which is what is at this point in time still missing, be it the global economics or the domestic inflation dynamics. In fact, if you see the Fed, I think it still have a long way to break the tight labor market in order to deliver on its core inflation target, because that is still looking to be a long drawn process as far as the US is concerned. Back home also, I don't think that if you look at the Reserve Bank's own forecast or market average forecast as well, most of us are talking about a 5.2 or 5.3% average inflation in the coming 1 year, essentially, which is still somewhere higher than their 4% medium-term target. I think same is the case with the Fed, because even though we will see a disinflation trend play out in a dramatic fashion, I think in the medium term, you are probably looking at a much higher inflation globally owing to various factors, which also means that the so-called 2% target that the Western economies have been, aiming at or have been focusing on probably will need a revisit in the next decade or so. So I think we are anyway getting into a period where, inflation variability is going to be much higher. That said, I think given the fact that, the recession historically has been a very, very strong and a very reliable disinflationary agent, there is no two way about the fact that we are going to be seeing a disinflation trend. The bigger question is that are we going to be seeing a sub 2% inflation which will sustain for the next 5 years or 10 years or so, or are we in for a inflation regime which probably is talking about a relatively higher average inflation over the next decade?
That's an important link, that this cooling off of inflation needs to be seen in a broader perspective. It might not all be good news. Geoff Dennis, you agree with that this might be pointing to the onset of recessionary trends as well?
I don't think so. I think it's a balancing act. And obviously, I think on the back of this, especially the core inflation number, there will be continuing fear. Plus, given, of course, the recent banking crisis and the tightening of credit conditions implied by that, there will be some concerns about, a return to, if you like, stagflation again. But at the end of the day, I think you're sufficiently far through this disinflation process that the Fed has got a little bit of wiggle room here. And meanwhile, although the economic data has softened, it still doesn't look to me like it's recessionary. And therefore, for me, a partial slowdown or a modest slowdown, which is what I think the data is telling you, is quite welcome, because that's the sort of thing that will mean the Fed feels it doesn't have to hike rates very much more from here. Bear in mind, if they move rates 25 basis points at the beginning of May, that's going to push real rates into positive territory just for the first time for many, many months. And so I wouldn't get too negative about it. I still think we're very close to the end of the Fed tightening. I still believe that although we have to watch core inflation very carefully, that this is not going to lead to over-tightening by the Fed, nor do I think we're going to have a recession, or if we do, it's going to be a very, very mild downturn. And so as we navigate our way through all of this, I think you're going to see continual opportunities to buy risk assets, including equities and including emerging markets. So the dollar's weaker today, which is very good for EM. And so recession's a risk for sure, but I'm not sure I see it coming, or if there is a downturn, it's going to be very, very mild. And what that will do is stop the Fed quickly and allow some of these risk markets to improve again.
All right, so we'll have to wait and see whether the trend continues, but something to cheer on a day when two important data points have come up. Thank you so much to all of you for helping us break down that very important story. And let's talk about the big numbers that have